Hi, and welcome to Midas Investing. Today we're going to be taking a look at Louisiana-Pacific, ticker LPX, which is a producer of engineered wood products, specifically for home building, siding, and trim products. They also produce oriented strand board, which is another engineered wood product made out of layers of pulp wood product for internal insulation in between major structural arrangements within home building products. I'm very interested to take a look at them again, what with the change in the valuation tools that I've been using on this channel since I last did my video on them. And also since that video, Berkshire Hathaway Warren Buffett actually took a position in LPX, which made me at least want to take a second look at it to see if maybe I had missed something with my previous valuation. Not to mention, it fits in well with the general home building theme that I'm very interested in here on the channel. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So coming over to Whale Wisdom to take a look at Berkshire Hathaway's most recent 13F filing from the last quarter, and we can actually take a look at their LPX position, which I know you can't really see the ticker over here on the left-hand side, but this line I have highlighted is it. And you can see that it actually only makes up a very, very small, minute fraction of Berkshire's portfolio. However, they themselves own almost 10% of the company now, what with a 21% increase in their share ownership with the most recent quarter. And again, according to this, they had been purchasing into the company as recently as, or as early as the third quarter of 2022 at an approximate price somewhere in the kind of like mid 50s range by their estimate, which with the current share price, you can see that they're at least slightly up. But it's worth noting that with them at about 10% of the company, that does kind of put somewhat of a likely limit on further increases to the share ownership. They would have to make further filings and arrangements to do so, which they could do. That doesn't mean that they won't do such a thing, but that does kind of create an extra roadblock to the likely increase in their position. So we can assume that they're likely to just maintain what they currently have or maybe trim from there, which I would say technically provides a potential headwind, what with such a large investor that owns 10% of the company, potentially having the wherewithal to sell out of the company at some point in the future. Though, of course, we are talking about the Oracle of Omaha here, who often takes, or is at least well known for taking very long-term positions. Though if you actually look at his record, that's not necessarily the case. And plus, we don't really know which of the managing directors or heads that were actually made this position. So there could be other aspects to the overall ownership right here that we don't necessarily understand. What I'm generally trying to say is that just because Buffett is a owner of this company doesn't mean that that should be your driving reason for owning the stock. You should have your own reasons for it, and don't necessarily be surprised if he's going to change his ownership at some point. Don't let that affect your perspective. So turning now to take a look at their earnings presentations, I actually pulled open here the earnings presentation from the fourth quarter, which is one quarter back, to take a look at the way that things were at least a little bit ago and their perspective on how things are going to go going into this year, at least one quarter back. And you can see that in the fourth quarter of 2022, they had 38% growth in the siding solutions on the quarter over quarter basis, as well as a 36% decrease in OSB price on a quarter over quarter basis. Now, I had mentioned that they have these kind of two segments, the siding and the OSB, the oriented strand board. It's worth understanding that the siding is kind of their more value added product, whereas the OSB, they do some value added aspects to it, but in a general sense, the pricing for that segment is very much a very commoditized kind of basis. It's very similar to a lumber, whereas the siding solutions, they can kind of add a little bit more specific value to the based around their brand and create a non-commoditized kind of pricing opportunity for themselves. Now switching over to that first quarter earnings presentations, this is part of why I want to start with that fourth quarter one, so we could compare a few of these details. The segment growth for the quarter, we can see that the siding solutions was relatively flat, which considering we had that large growth in the previous quarter on a quarter over quarter basis, it's okay, I think, to see us at least flat in this one, especially not backtracking further. But what we can see is that the OSB price came down about 68% on this quarter over quarter basis, which really just shows how high the elevated levels of lumber and wood panel pricing generally was in the first half of 2022, coming out of the high levels of 2020 and 2021. So really, we're just kind of coming back down to a more normalized level, and we'll definitely be talking about lumber prices here shortly. Switching over to their 10K, there's really just a few details I kind of wanted to point out here that just shows some of the qualitative aspects of LPX that I think makes it understandable why maybe somebody like Warren Buffett would be interested in investing in them, is because I think that they do a very good job of making their business understandable and giving you all of the information in their 10K that you really need to build up a very comprehensive understanding of their business. So right off the bat, we've talked a bit about the segments already, but I kind of wanted to show the actual split of it here, just on the general business page that they have. You can see 38% of the revenue in 2022 was for the siding, which, as I mentioned, is kind of more the value added, higher level, non-commoditized segment that they operate in. So the more we can expand into that section of their business, the better, I would say. Versus the oriented strand board, OSB, which makes up 54% of their sales, which is a little bit more of like a commoditized wood-based segment. South America, which is technically a mix between the two of them, and it's just segmented off by geography. But for the most part, their sales in that segment do make up more of the OSB section of the business, which makes up another 6%. And then we obviously have 2% for other and some intra-segment stuff as well. Next, if we come down into the 10K a little bit further to where they discuss the segments in higher detail, they give us a lot of really, really useful information, which this is the type of information you do see a little bit more commonly with lots of other companies. But still, even so, they have very, very thorough information about the volumes and pricing by segment, which is very, very useful information if you're trying to build out a model. And a lot of companies really skimp on the type of stuff they give you. Not to mention, they also compare it very thoroughly with strong macroeconomic indicators like housing starts, both in single and multifamily. And then one other interesting piece of information that they gave that I really thought was very useful is this metric that they call overall equipment effectiveness, which is effectively them making a gauge of just how much of the capacity of their overall equipment and the properties that they're actually making use for. Or at least that's kind of the way I'm thinking about it, is that you take their overall volumes levels, and you can kind of work backwards to figure out what the potential capacity would be like if they were running at 100%. But then they also provide this going back for at least a few years. I would think I was able to get 5 or 6 years of this particular metric, which is pretty useful because it at least gives us an idea of like how this trend moves over time. Not to mention, it can give us an idea of just how much further capital expenses may be required for the potential sales growth that we're looking for in our model. All right, so now I want to take a look at some of the operating metrics over time for LPX. Right here on the screen, I have various profit margins for the company, including their operating margin, net income margin, as well as free cash flow margin, and the 3 lower lines that are all moving together, as well as the gross margin that's kind of trailing above it. I can see how strongly well together the operating income and free cash flow lines are, and that's partially because they've operated at pretty low leverage levels without too many other non-operating revenues or expenses as well. So that kind of flows generally together. But the reason why I wanted to show this graph in particular is to kind of give us a sense of scope comparative to the more recent operating margins. If you look at the company over the last 1 year, 2 year, 3 year, a lot of people, when they're looking at the history of the company, they really only look at the most recent couple years. It's going to give you a very skewed perspective on the type of profit margins this company is experiencing, which isn't because they made some massive changes to the way in which their business is structured that's going to allow them to have higher margins going forward, but comes primarily from pretty large changes in that commodity-based pricing, as we were talking about, that OSB section of their business. And this is something they actually talk about a lot in their 10K and in the transcripts to their calls. So we should really be thinking about more of a normalized operating margin range, which if you look at that, you can see, for example, for the years 2014, 2015, they even had some moderately negative operating and profit margins. But for the most of the kind of time frame up through 2019, you can see it's kind of up in this mid range between the 0 and 20% line, maybe a little bit less than 10% back in 2013. And then for the years after that, those lost years, we can see maybe up in kind of like moderate teen levels, up into maybe even 20% level for the operating margins for a couple years as well. So I'm only using the time frame going back to 2017, as you can see right here, which is because of negative earnings for periods earlier than that on the time frame, which makes the skew of the multiples become less meaningful. So I really wanted to maintain a period in which the multiples were at least still had a strong meaningfulness relative to the actual pricing, which still even so gets stretched a little bit for this period, as you can see right here in 2020, where they had a significant drop in their profitability, which led to much higher multiples they were trading at because the market at least maintained some sort of price buoyancy for them during that time frame. But even so, I found that it didn't skew the averages too dramatically. I did kind of play around with the timeframes to see what it looked like in just kind of these time frames versus this time frame. And overall, I decided that this kind of bump up wasn't too dramatic of a skew for what I was just trying to get an image of right here, which is to say, if you could look at these multiples, which the ones that I included is the trailing enterprise value to EBIT, as well as the next 12 months enterprise value to EBIT, as well as the next 12 months PE ratio, which you can see I didn't use the trailing PE ratio, and that's because of large skews in the numbers there. I wanted to at least have something that was easy to look at and reasonably meaningful. But either way, you can see that they've generally traded in kind of this range of maybe up to around 20 of kind of like a high level for some of the kind of the kind of periods that stand out a little bit, but for the most part they've traded maybe in kind of like low teens to maybe upper single digits, relatively low single digits in the more recent couple of years. But I think that has reasons that are pretty easy to understand. The average across the multiples being 11, around 10, maybe 13. And then again, you can maybe say that there's some slight skew there that maybe brings that number back down to maybe a more moderate range. But either way, possibly like 11 to 12 range. 2/3 of these multiples are forward multiples, which does tend to skew a little bit towards the lower end as well. All right, now before we set up for the model that I made for the company, I wanted to share some information about the pricing of oriented strand board, as you can see right here in Canadian dollars versus some of the composite measures in United States dollars, and how that compares against lumber pricing, which you can see generally has the same sort of price movements, though not necessarily the same absolute values, which is something I kind of wanted to point out because for building out the price expectations for the segments in our model, we are going to be relying on the growth rates that I've already put together for lumber prices, which I used in a previous valuation, specifically my Interfor lumber forestry valuation, of which I made bear case assumptions of lumber prices moving at about a 0% growth rate for the next 10 years, a base case assumption of it growing at about 2.6% per year, and a bull case assumption of it growing about 5.2% per year. I'm going to be relying on these exact same growth rates for my price assumptions in OSB segment for LPX. All right, so taking a look at our model, you can see I separated each segment off into both volume and price for citing OSB and South America, with other kind of, we're just using a relatively simple average since it's mostly just a reconciliation of a couple $1 million in the excess. But for the switch over between volumes and pricing, I'm mostly relying on the more recent year of volumes and taking that level of demand as somewhat representative of the current levels of production that the company has for the facilities that they have. And then this is kind of relevant to what I was talking about earlier with the overall equipment effectiveness measure that the company reports in their document. So I'm using those percentages that they report, as well as the volumes that they report of production for each of these segments, to then come up with an implied capacity for each of these segments as well. So for example, you can see in 2022, they had volumes of about 1.8 million in siding, but according to the 76% effectiveness measure that they gave, that gives us an estimate that they could have potentially had possibly 2.4 million or so. And then likewise 5.2 million for OSB, or 827,000 for South America. And then these metrics go backwards in time based off of the previous years of information. This is relevant because, like I said, we're going to be making some projections about where we think volumes are going to go, and then we want to compare the current implied capacity to where we think the volumes are going to go, to show that we don't really need to actually build out that much more capacity for the model to be internally logical. Now, as far as the pricing for each segment, I'm actually going to be relying on the average of the historic timeframes that I have of the price as kind of like a normalization factor. So we, for example, in siding, the implied pricing was 817, but the average pricing over the years that I have here, which is only 7 years of information because they kind of had segment information changing a little bit in previous years. But either way, that gets an average pricing of 684. And then likewise 350 on average for OSB, and then 317 for South America. And then we're going to be using the growth rates that I was talking about, the implied lumber growth rates based on these averages, which makes sense as well compared to the way I used those same growth rates in this other valuation, is I was using it based off a normalized 10-year average of lumber prices. So that's part of the reason I'm using that particular methodology. Now, they also supplied pretty thorough information on their segments, all the way down to the EBITDA, identified assets, capex, and free cash flow levels, or at least we could get to the free cash flow levels based off the other information which allows me to then not only build revenue expectations for these models, but also margin expectations based off of them, at least just basically going back to their longer term averages in each of these segments. And then the growth of each of these segments then changes the overall margin for the company based off of the composite changes of the revenues for those segments. So anyway, coming over to the actual expectations of change for this model, as I was saying before, we're for the most part we're going to be relying on pretty simplistic assumptions for the growth rates of the lumber and the siding segments. In particular, you can see right here is where I have the 0%, 2.6%, and 5.2% for the OSB. And then as far as the volume expectations for OSB, they had shrank for about 1.5% per year during that 7-year time frame. So I'm going to assume that basically they continue to shrink in volumes likewise over the same time frame. It seems like they've been slowly trying to focus less and less on the OSB section of their business. Now they grew the siding section of their business in volumes by about 7% per year during that same time frame. I don't think that they can grow quite at that same level again, so I'm going to decrease that growth rate by a factor of 1.5 or so, and that's going to get us to a volume growth for siding of 4.7%. So 4.7% growth of volumes then gets us to 2.8, 2.9 million in total volumes for the siding, which if we compare that to the levels of siding capacity that we already had in 2022, as I was just saying, that's 2.3 million. So you can see we would have to build some capacity for siding to make that happen, but we're not too far off. And then likewise, we can compare the volume levels we got up to for OSB, the 3.2 million or so that we get up to in 2032, and compare that to the 5.2 million of capacity we have in OSB. So we actually have more than enough capacity in OSB. And actually, I would argue that you can maybe even convert some of that capacity over to siding, especially considering there's so much more in excess. And then for South America, we likewise get up to 837 million or 837,000 in volume expectations for South America. And that's based off of us assuming that they continue to grow at 3.6%, which is the same amount that they grew for the previous time frame, which since I found them to be mostly like OSB, but somewhere in between OSB and siding in terms of how the actual sales of that segment goes, I decided to kind of just allow it to maintain that same growth rate since it's also the smaller segment between the three. And then, as I said before, for the other segment, I mostly just relied on a pretty simplistic assumption of it maintaining the same level or so over time. And then in terms of the pricing for the other segments, because I talked about the growth rates for the OSB, I based my growth rates for the pricing for the other segments around those same assumptions. As I said, the South America segment is for the most part like the OSB segment, so I relied on the same growth rates, the 0, 2.6%, and the 5.2% for that. But then for siding, since it is a higher value added segment in general, I decided to increase the growth rate expectations by a factor of 1.5, like I did with the volumes of decreasing the expectations by the same factor, which gets us to growth rate expectations of 0%, 3.9%, and 6.5% across the bear, base, and bull case assumptions. So that gets us all the way to total revenues across our bear, base, and bull case assumptions for LPX of 3.4 billion or so in 2032 for a bear case, 4.7 billion for the base case, and about 6 billion or so for the bull case. Now, as I said, they did give us pretty comprehensive information in terms of expenses all the way down to capital expenses. So I was able to make some implied expectations for free cash flow yields based off of at least us kind of maintaining a kind of return to steady state assumption around these segments, though allowing for the differences in growth as we kind of talked about. And that gets us to an implied assumption of 8.3% for the internal free cash flow yield in the bear case assumption, 10.3% in the base case assumption, and 12.8% in the bull case assumption. So kind of about maybe a 10% or so across those three cases. And I'm definitely going to be relying on that as kind of like a cap assumption to a certain extent because of some of the bullish assumptions I actually did use for these kind of revenue assumptions. I'm willing to kind of assume that this is maybe the upper end of the scale in terms of where things can go. In fact, I believe the end assumptions I end up with in my valuation is more like 7 to 8% or something like that. Now, coming over to the financial statements, I did kind of want to point out some of the kind of averages of the metrics we were talking about in the images I actually already showed a little bit. For example, the operating margins over the 10-year time frame on average are about 15.5%, but we are kind of talking about trying to return to a more normalized level in terms of where they were prior to the craziness of the last few years. So if I take a look at that, the average was actually more like 7.5% for 2019 and backwards. But we also talked about the 2 loss years that are a bit of an outlier for them in there. So if I was to take those out of the equation, that actually gets us to more like an 11 to 12% for a margin as well. So you can kind of use that as somewhat of a guide zone in terms of operating margins. Now we were just talking about the free cash flow yield, so I also kind of want to compare that to the free cash flow yield, which if we see the free cash flow yield over the entire time frame, it averaged about 11%. And I was again just comparing that to a possible kind of potential future free cash flow yield of maybe like 10% or so. But this is also again including these very, very high level free cash flows of the most recent few years of craziness. So if I take those out of the equation, that ends up more like 4.5%. But again, we still have outliers in there. So maybe if I take those out of the equation, that gets us to more like 7 to 8% now, which is kind of in the range of what I was saying, I think is actually more like a reasonable expectation. Another way to kind of think about the capital efficiency of how we're going to get the free cash flows is the reinvestment as a percentage of sales. Reinvestment as a percentage of sales over the 10-year period has been about 1%, which I think is actually a pretty good guide zone, even across the crazy years. I think that doesn't necessarily throw that average off too much. In fact, if I look at the average, even out not in counting those years and taking out the outliers, either way, I still end up with like this kind of 1.25%, and pretty much no matter how I mix or match this number. And what with the large uncertainty surrounding the near term in terms of revenue and profitability for the company, I did want to take a look at the current expectations as they are for the next few years for the revenue and EBIT numbers, and how that compares with the valuation numbers that I put in place. For example, you can see right here, the 2023 expected revenues for the company is about 2.6 billion, according to 10 analysts, 2.9 billion for the year after that, and then 3.1 billion the year after that, according to 3 analysts. Likewise, the EBIT for this year is expected to be less than 300 million, according to 9 analysts, about 400 and change million, according to 8 analysts, and then 480, 490 million, according to 3 analysts thereafter that. So you can see huge drop off is expected this year, but with some quick bounce back, maybe not to peak levels, but at least to pretty strong levels, assuming these numbers are going to be anywhere close to accurate. So coming over to take a look at our valuation, you can see the revenue expectations as I put in place here, aligned with our model expectations. We have about 3.3, 3.4 billion for the bear case, 4.6, 4.7 billion for the base case, and then about 6 billion or so for the bull case, with expected revenues for 2023 and 2024 dropping down to the levels we were kind of seeing in terms of the analyst expectations. I'm a little bit higher in one year, a little bit lower on the other year. 2025 levels, I'm actually a pretty significant level behind them. So I think being a little bit more conservative in the short term, at least in terms of like how they recover from this decline for the revenues. And then if you come down here, you can see kind of the cumulative growth cases over time of the next 10 years as I kind of put it in these bull, base, and bear case assumptions. I am leaning a little bit more optimistically towards the bull case than the bear case. And then likewise, we come over to the expected operating income. You can see that in the short term, I have operating margins dropping down into relatively moderate single digits, getting us down to 200 million or so in EBIT, which is lower or similar to the kind of analyst expectation numbers as we were just talking about. And then the bounce back is a little bit slower than was expected according to the consensus numbers, but then really starting to pull back to pretty strong numbers by the kind of midpoint of our evaluation, and then moderating back down to kind of this kind of 13 mid 12s operating margins for the terminal year. You can see the kind of range of operating margins on this graph right here, with the distribution of operating income in that 10th year listed right here. Pretty wide range of operating income, but pretty solid in this kind of like maybe 600 million expected value spot. And then similarly, as I had said with the reinvestment levels, our net reinvestment ends up being approximately a little bit more than 1% of sales per year on average over the 10-year time frame, which builds up our invested capital accordingly, and then gets us to returns on invested capital, which are on average for the first 5 years kind of in the high teen range before returning back up into kind of the mid 20s range, moderating itself over time into the terminal year. Free cash flows for the first 5 years averaging about 200 million and change, and then for the next 5 years after that averaging a little bit over 400 million. With the distribution of those outcomes, you can see as well right here. And then if we put it all together and apply discount rate assumptions, that gives us an implied terminal multiple in kind of the low to mid teen range, which is I think appropriate given what we've seen in the pricing history for the company. That gets us to an expected value of kind of the mid 60 range, with the expectations of value ranging anywhere from $55 to $73, with about 50% of the value expectations in between there. Coming down, we can take a look at the fair value distribution, as you can see right here, with the expected returns accordingly over here. We did see the price get down to, I believe, in the 57s pretty recently. I did not pull the trigger at that point, but based off of these assumptions, maybe that was a poor thing not to pull the trigger on, but who knows? Maybe we'll get another opportunity at it here in the near future. And here you can see a basic summary of the expected valuation case with the fair value at about $65 per share, sitting at about the 47th percentile of the value distribution that I've created. Fair value is about 3% higher. Expected returns over the next 10 years about 9.5%. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it with our evaluation of Louisiana-Pacific, ticker LPX. As you can see right here, it's currently slightly undervalued, though it was not too long ago a little bit better of a margin relative to the expectations we have in place here. I certainly will be watching it like a hawk, and I'm very interested in starting a position on it, but I would like to see a margin of safety at least similar to what we saw not too long ago. I'll catch you all in the next one. Bye.